Good morning and welcome to another Main Management Weekly Market Note. Hope everybody had a nice long 4th of July weekend. As always, I'm Alex Varner, here, Director of Research at Main Management, alongside
James Maxwell, VP of Research.
Let's get into the note for the week. Mostly positive for the performance data. Things kind of finished out the end of June and first week of July at basically at all-time highs. That's a remarkable recovery from where we were 3 months ago. The trailing year-to-date numbers are, largely positive as well. You've got the two sectors in the red are consumer discretion and healthcare. But industrials, comm services, and infotech leading the way year to date for the sectors. And Europe is still leading the US pretty handily, up over 24% for that Euro stocks versus the S&P up 7 and the NASDAQ up around 9. So still seeing some international outperformance there on the year to date, which, again, the question is, how long does this last? We had a head fake a couple years ago where it was like you had like a whole quarter. Now we've had 2 whole quarters of outperformance. And I think
slowly getting longer.
Yeah, we'll see. And I read something today that, coverage, I forget who it was, but it was shifting back to favoring the US given the run we've had of late, and really playing some massive catch up. So we'll see if this continues, if Europe can hold its lead or what. Recession Dashboard, again, not much changed from the prior month. The data, I think, has just been kind of, the economy's chugging along. It's not super strong. It's not frighteningly weak either. I think it's kind of better than feared has been kind of the theme, and things are just moving along. On the recovery note here, we talked about, from April 8th's bottom, it came back, and it was, I think, one of the fastest recoveries from a down 15+%. And, the concern people are asking is like, okay, have we run out of breath? Like, have we kind of used it up? The answer here, the long and the short of it is no. And a year later here, there's, 8 or 9 instances where you recover from an 18% drawdown within 3 months when you're back to new all-time highs. And forward, it's 100% of the time you're positive 1 year out by an average of 21.5%. So pretty solid. I think it's also important to remember here, people are like, well, do I buy at all-time highs? Do I not? And like the market's at or near all-time highs, like 90+% of the time. I think it's within 5% or something. So it's, as it keeps going up into the right, you keep going up into the right when you make new highs. That's how that works.
It feels bad to say, well, it's the highest it's ever been, but do I want to buy? But then if you look at the data, look at history, it's like, it's worse to just kind of wait and sit on your hands.
If you're waiting for a big correction, chances are you're not, you're going to get one far less frequently than you do continuing to move higher, especially with kind of earnings continue to be pretty solid as they've been. On the biggest data point last week was the non-farm payrolls. We have the first week of the month is usually pretty employment heavy, but non-farm payrolls June came in well above forecasts, 150K, 147 versus 110. Under the covers, a little, I don't want to say cause for concern.
But still a bit weaker or less strong than
exactly. Kind of that headline is maybe a little misleading because you saw the labor force shrink by 130,000. The number of unemployed declined. Household employment was up 93K, but the participation rate ticked down. So the way all these kind of math pieces work is part of the reason that the unemployment declined is people move out of the workforce. So it's not because they found a job, they just stopped being counted as part of the labor force, because you have to be actively looking for work to be classified as unemployed. And if you stop looking for work, you become not unemployed, even though you are unemployed. You're just not
part of the labor force.
Exactly. So the numerator and denominator parts can be tricky here. But that participation rate, not great to see that tick down. Unemployment rate tick down. Again, that's, I think, because people left the labor force. Those unemployed fell out, which again helps the math there, but not necessarily, kind of a good develop for good reasons. I guess I'm trying to say. And here you see those not in the labor force up 330,000. So this is people kind of exiting the labor force, which is not great. And then earnings decelerated a bit, but still handily outpacing inflation. We look at the participation rate here, as we mentioned. It's good to see the 25 to 54-year-old participation rate. That's kind of the prime working age cohort ticked up to 83.5%, even though that overall one declined. The overall decline was driven by basically declines in other age cohorts, specifically younger and older, and really the younger folks. But that 25 to 54 is kind of holding steady, which is really what you do want to see, because that's the prime group. And then on the right, worth noting that discouraged workers, and again, this kind of speaks to maybe a little bit of the less strong and people leaving, is that discouraged workers shot up to 654,000, up 300,000 from a month prior, which is the biggest gain on record. And those not in the labor force and want a job now also kind of moved up to a post-COVID cyclical high at 6 million. So it seems like people are having issues finding jobs, and we'll talk about the JOLTS, the openings and hires in a minute here. But I think in this report, that disconnect kind of seems like people are just having a hard time finding jobs.
Yeah, so they're kind of giving up to some extent and maybe they're going back to school or going and doing something else that doesn't, it's not explicitly looking for a job. So one of those like statistical quirks of this jobs data is you want to count, well, how many people are looking for jobs and how many people are in those jobs, or how many people are unemployed. And as a result, you kind of get these quirks where if that number moves around, that number of people that are quote unquote in the labor force moves around, it can look better than just off of that number going down.
Yeah, then the reality where the denominator has shrunk, which is not necessarily a good thing, but because that shrunk relative to the numerator, then the rate goes down. Or up, depending on how on what you're looking at. But I think part of that is just people are having issues, and labor force again, as we said, down 130K. So we'll see if that kind of maybe continues or not, I think. But again, there's some kind of softness to this data. Part of it also was the government really played a big role in that 147K. They hired 73,000 people. So that's basically half of the government. Again, that was at the state and local levels. The federal government shed 7,000, but local and state governments were up 47,000, and then the federal government is actually down around 70K from its peak in January.
On the private sector side, if you look at just that, it looks a lot weaker than the kind of total number, which includes government. Obviously, because that total number, about half of it was from the government. On the private sector, there was an interesting stat that, like, if you look at the industry basis, this is known as the diffusion index, but basically it's telling you that over half of the industries lost jobs in the private sector in June. It was just around like 49% gain jobs, so just over half, but still shows you that kind of the breadth was pretty weak in June, even if the headline number again was strong because of some outsized concentration in a couple industries.
Yeah, and if you look over on the left side here, those dark blue bars are the private industry jobs. And that's the smallest reading since we basically had that zero, 8 or 9 months ago. So this is definitely weaker, and then you can see the government, the green, is the strongest it's been in several months. So kind of definitely a mix shift
there's some
there.
I know there's some seasonality too with that, because it's state and local. A lot of that's like schools or different kind of seasonal workers that can skew the data.
And then on the wages, just to touch real quick before we move forward, they were up 0.2 month over month, kind of missing forecasts. They slowed to 3.7, which is the lowest since July of 24. But again, we look at this relative to inflation because that's our people getting real wage gains, and these continue to outpace inflation, which is right, 1% lower, mid twos. So that's a good thing as far as wages continuing. And that's also important to remember that we're still basically at or above pre-COVID levels. Wage gains pre-COVID were like closer to 3%, and we're still running at 3.7. So it's still slowing, but it's still normalizing.
Still positive,
it's still normalizing from some of those big distortions you can see on the chart here. The JOLTS number is a little delayed again. This is May for JOLTS versus June non-farm payrolls. But basically, kind of as we assumed, ongoing steady labor conditions. Openings came in above forecasts, which is a good thing. Hopefully you can find some matching of, if openings are improving and people are having a hard time finding jobs, you want people to move into those openings. Hires ticked down, quits were up a little bit, and then layoffs fell to 1.6. So that's a good thing. The quits, the quits down isn't, the quits ticking up is indicative of, a little bit better worker confidence, because people generally quit when they think they can find another job. And then the layoffs down is good. So that's, the layoffs declining is a solid development. You don't want to see those kind of start to move meaningfully higher. On the ADP payroll, so ADP is the private payrolls. This number came out on Wednesday ahead of the non-farm payrolls Thursday, and it was a big miss. It fell 33,000 in June, first decline in basically 2 years. Over 2 years, and it was well below forecasts, which were for plus 95,000. One of the concerns here or issues is this has been pretty inconsistent with the BLS reading, the official non-farm payrolls, and I've never gotten a really good explanation as to why it doesn't work. But
Yeah.
there's a monthly delta of around 75,000, I think, is what they've kind of calculated, which is kind of hard to believe.
Yeah.
And these numbers do get revised, and they realized a while back that they were having structural issues, and they went back and like tried to rejigger the whole process. And maybe this is a fluke.
Yeah. From my understanding, kind of pre-COVID, this was a much better, almost like an early flash reading, a couple days early on the actual like official payrolls number from ADP, which is the largest payroll management company. They're able to look at the data that they get and show how many jobs were gained or lost post COVID. It's one of those continued statistical quirks, or that those distortions in the data where the relationship is kind of fallen apart and its predictability is just like fallen off.
Yeah.
As you're talking
it's
about.
It's been hard. The concern here, again, we don't want to completely discount this, is that this is showing weakness in small and medium-sized businesses. And those are the vast majority, as we show here. Small and medium firms account for almost over 80% of employment. So to see those slowing numbers, and small and medium is basically firms, I think, up to 150 or 250. I'm sorry. Is it 250 or is it 500? Can't remember what no, sorry. Small and medium is up to 500 people. Large is 500 plus. But the concern is that you're seeing the businesses that drive employment, are really responsible for the bulk of employment, slowing. And that's a concern. You can see on the left there, that yellow line has been slowly ticking higher, and it's up to 18.3% for large firms, which is an all-time high. And then on the right, you see, kind of the ADP payroll breakdown by industry, where you had leisure and hospitality up 32, which is definitely a seasonal thing. And then on the bottom side, however, you had education and health services and professional and business services, which lost 100,000 jobs in clients. So not a great reading on ADP. We'll see if this magically gets revised next month. Sometimes that happens. But again, a minus 33 versus plus 147 is...
And if you look at the private sector part of the non-farm payrolls, you can see that the weakness, it looked not as weak as the ADP, but you can see how there's a more direct relationship there. Once you include the government, that obviously distorts things this month. So maybe it's a bit, there's some directionality there that's correct, but obviously not as weak as down 33,000.
Yeah. On the another employment data point we get is Challenger, Gray, and Christmas job cut announcements. They do hiring and cut announcements, and these, keep in mind, these are announcements. So this doesn't necessarily come to fruition, but if a company comes out and says, we're cutting 7,000 jobs, that gets picked up by this reading. Whether or not they cut any jobs, there's no accountability on this. It's purely announcements. But it does kind of give you some directional info. The cuts were down to basically 48,000 in June, but year to date, we see cuts are now at 744,000, which is the most since 2020, so through a half year. And, it's honestly more than every other full year since at least 2012.
Wow.
So cuts are really, the announcements at least, have been furious for the first half of the year. Hires fell to just a really low 3,100 basically, or 3,200. That's the second lowest monthly reading for which we have data, behind December of 23. So hires now year to date are at basically 83,000. So you have 740,000 cuts and 83,000 hires announced, which is a delta of like 90%.
Oh God.
And that's the biggest trailing delta since through the first half of the year, through 6 months, because they do a lot of year to date comps on this. So hires have some ground to make up. And again, September is always a seasonally huge month because of the Christmas holiday. But again, this is the biggest delta we've seen, and we have yet to have a year where hires do not outpace cuts. Hires always outpace cuts. The last 2 years got really close, like closer than they've ever been. So we'll see if this year maybe finally breaks it. But it's going to be going to come down to the wire.
We have 6 months.
6 months for hires to come on back here. And again, the reasons, the biggest cuts here have been Doge actions, downstream as well. Market conditions have been responsible for a good chunk as well. But basically Doge is up 40% of the cuts that have been announced. And only a few industries have announced. We look at net hires versus cuts, so how many hires have announced versus how many cuts. And government obviously is just down massively because of the Doge actions. But you've got only 4 industries with more hires than cuts. That's entertainment, leisure is leading the way up, 20,000. But that government is just, that's rough headline with 275,000 more cuts than hires. So
it's funny, all this employment data. Obviously, we just talked about like 3 different employment pieces, or actually 4.
Four.
on the kind of low end, or on one hand, there's the Challenger, which kind of looks very weak. There's a lot of cuts, along with like ADP is also relatively weak. And then on the kind of like better end, you probably would say like non-farm payrolls and jolts, which look.
Jolts is probably the most solid one.
Yeah, they just look fine. They don't look particularly strong, but it's kind of muddling along. It's fine. It's nothing crazy on either end. So I think it's like interesting how many different reports there are on employment and how they're kind of telling you a lot of different things. You can look at like weekly unemployment claims is another one that's looking relatively weak, but that's obviously
and there's a lot of seasonality.
Yeah, there's a lot of seasonality. There's a lot of like noise in that data because it's inherently hard to calculate like how many jobs are in the U.S. At any given time, especially at like a real time basis. But that's why you have to look at like all these different reports, and you can look at one and it might tell you one thing, you might look at another and it tells you something completely different. So just something to keep in mind.
Indeed. And the big last piece for the week, I think, is the trade balance. This has been watched just given the tariff, import, exports, pull forwards, but you saw a pretty big retracement here. Following, April had the big contraction from March to April, and now it widened a little bit at 71.5 bill deficit. But imports are basically unchanged, while exports were down 4% month over month, which is the biggest decline since April 2020. But again, you still have to think there's some tariff related stuff here. I think it's just hard to kind of accurately portray what's going on, given the constant change in rhetoric and policy and pricing and who knows. But the good news is that at least trade policy uncertainty is down. It's down almost 60% from the recent peak back in April. But still, that's outside of that peak, it's basically its highest levels relative to recent history. So it is declining, moving in the right direction, but still elevated.
That matches the headlines. You saw this headline with the Vietnam potential kind of framework of a deal, which is going to be the third one potentially, but continued kind of uncertainty there and pushing out of these.
Now we're at August 1st.
Yeah, August. Pushing out of the of these reciprocal tariffs. So TBD on a lot of this trade stuff.
Yeah. And I think it's interesting. They do go into the different categories, and it's the imports were non-monetary gold was down the most, natural gas, and finished metal shapes, which I just like the way they categorize these things and what they decide to call them. But keep an eye on the trade balance going forward. And we had manufacturing PMIs. So those are actually kind of showing some signs of life here, trending up a bit. The BRICS average was kind of the one that really declined. But again, we're still doing a simple average of Brazil, Russia, India, China, where China is easily the biggest player in the BRICS. And that improved. So the simple averages can be a little misleading. But we're just showing it for the ease of, and technically I think Russia's out of the picture still.
And if you look at that left-hand chart, it's kind of slowly moving up, ever so slightly, as a kind of global manufacturing average. So barely, just barely recovering now, after a couple of years of struggle.
Yeah. And then on the right, within the U.S., you have the S&P, the ISM, and the Chicago. And both S&P and ISM kind of ticked higher. Chicago's been mired in contraction for a while. But I think the S&P and the ISM are broader. Chicago is regional. It's kind of thought that Chicago, as that region goes, so does the U.S. But clearly you're seeing a bit of a disconnect here between that region and the broader U.S. readings. So kind of in summary, we've got this remarkable comeback from the S&P 500 since the April 8th lows. Forward returns have historically been strong from here. Non-farm payrolls surprised the upside on the headline number. Some softness within that report. Jolts chugging along. ADP was pretty damn weak. But again, that's a smaller sample size and private only. And then Challenger grade job cuts. The cuts, the announcements at least seem pretty bad. But I think it's important to remember that these are announcements and not actual cuts. Finally, you had the trade balance, which kind of widened a little bit, and then the manufacturing PMIs maybe starting to show some signs of life. We had a pretty heavy data week in the shortened 4th of July. This week is the opposite. It's
much lighter.
Slim pickings. But you got NFIB, small business optimism on Tuesday, wholesale inventories, and unemployment claims, and that's kind of it for the week. Ahead of, I think we get inflation next week.
Next Tuesday, I believe.
So PPI and CPI, or CPI and PPI are the big ones next week.
That's definitely something that we'll be keeping an eye on because you're kind of continuing to see, are there these inflationary impacts of tariffs? That's to be determined. It's not looking like it's all that, or they're being all that inflationary.
Yeah.
At least for the June numbers, but or the prior numbers, but we'll be
yeah, I've seen some. I mean, some of the kind of inflation now capturing stuff is very low numbers for what we might get for June.
Yeah.
So we'll see if that comes to fruition or not.
Yep.
But for the time being, hope you had a great holiday weekend and look forward to joining you next time.
All right. Thanks.